Hello everyone and welcome back to the QuantScore Financial Show. We are back again with our undervalued and overvalued stocks for the week, chosen using our very own metric, the QuantScore, a powerful algorithmic prediction tool that analyzes numerous financial metrics to give advanced predictions for the market. Now, before we continue with any further details, please remember this video is not financial advice. It is strictly for financial education and for entertainment purposes only. This week, we will be analyzing 9 different companies across various sectors, 4 companies we feel are undervalued, and 5 companies that our predictions are flagging as overvalued. We'll be covering everything from their quant score to their price-to-earnings ratio, so stay tuned to learn about the best opportunities in the market this week. First up, we're heading over to China to take a look at Li Auto, ticker symbol LI. A rising star in the electric vehicle market, currently trading at $24.75 a share, with a market cap of $25.8 billion. Li is part of the ever-growing commercial electric vehicles industry. What is most interesting about Li Auto is their impressive quant score, currently sitting at 18, a staggeringly high number compared to our other undervalued gems. Li's forward PE ratio of 15.6 also indicates potential for growth. And while its quarterly revenue growth took a slight dip, they were able to achieve a quarterly earnings growth of 17%. Overall, Li is showing strong fundamentals and a positive trajectory in a rapidly expanding market. Li Auto is definitely a company to keep your eye on. Currently down 4.29% on the week, giving it a potential opportunity to buy during a dip. Next up, we're switching gears entirely, diving into the world of pharmaceuticals with Royalty Pharma, ticker symbol RPRX. Royalty operates a bit differently than your typical drug manufacturer. Instead of developing their own drugs, they buy royalties on existing pharmaceuticals, providing them with a steady stream of income. RPRX is currently trading at $25.84 a share, with a market cap of $15 billion. Now, while its quant score of 13 might not seem as impressive as Li's, don't let that fool you. RPRX operates in a completely different sector with its own set of metrics, with a PE ratio of 10.04 and a forward PE of 8.58. RPRX is showing us strong signs of being undervalued. Its quarterly earnings growth is a whopping 17.3%, coupled with a solid 6.59% quarterly revenue growth. What I like about RERPRX is its stability while still providing consistent cash flow for the business and its constituents. So if you're looking for a potentially undervalued company with a history of solid returns, RPRX is definitely worth a closer look. Now let's talk about something a little closer to home, literally. Celsius Holdings, the maker of the popular Celsius energy drink, has been absolutely crushing it lately. With a share price of $28.80 and a market cap of $6.19 billion, this company is on fire. Celsius boasts a quant score of 11, driven by its incredible growth metrics. Their quarterly earnings growth is a staggering 18.7%, and their quarterly revenue growth is even more impressive at 62.9%. However, before you go all in on Celsius, there are a few things to consider. Its PE ratio is reasonably high at 36.58, with a slightly better forward PE ratio of 27.25. This sadly suggests the market has already priced in a decent amount of future growth. Additionally, while Celsius has a decent return on equity of 8.97%, its return on assets is a meager 0.72%. This indicates that they might not be utilizing their assets as efficiently as they could be. Overall, Celsius is a classic case of high growth, high valuation. While their recent performance is undeniably impressive, it's crucial to determine if they can maintain this momentum in the long run. Let's face it, everyone loves a good burger and fries every now and then, and that's where Restaurant Brands International, ticker symbol QSR, comes in. This fast food giant owns some of the biggest names in the business, including Burger King, Tim Hortons, and Popeyes. QSR is currently trading at $64.94 a share, with a market cap of $29.43 billion. While its quant score of 7 might seem low, remember, we're looking at a mature company in a well-established industry. What's interesting about QSR is its potential for being undervalued. Its PE ratio of 16.34 and forward PE of 12.22 suggest there might be room for growth. And their recent earnings report supports this, with a quarterly earnings growth of 37.3%. However, it's worth noting that their quarterly revenue growth was negative 0.8%. This could be a temporary blip, or it could signal deeper challenges in the fast food industry. On the plus side, QSR boasts a solid return on assets of 3.99% and a return on equity of 5.86%. If you're looking for a potentially undervalued company with strong brands and a history of consistent performance, QSR could be worth adding to your watch list. Now let's shift gears from our undervalued stocks of the week and talk about a few companies we feel are overbought and need a rebalancing in their future. The first company on our list that fits that criteria is Constellation Energy, ticker symbol CEG, one of the largest producers of carbon-free energy in the US. With a share price of $252.40 and a market cap of $69.97 billion, CEG is a true energy giant. This high score suggests that the company might be overvalued, especially when you consider its PE ratio of 24.69 and forward PE of 24.33. Now, don't get me wrong, CEG has some positive aspects. Their quarterly earnings growth is a healthy 22.9%, and their quarterly revenue growth is an impressive 69%. They also have a solid return on assets of 9.06%. But here's the catch, their return on equity is a mere 4.06%. This discrepancy suggests that CEG might be relying heavily on debt to fuel its growth, which could be a concern in the long run. Overall, CEG is a complex company operating in a volatile industry. While their recent performance is impressive, their high quant score and reliance on debt warrant caution. Remember when everyone was obsessed with Roblox? Well, the gaming platform's popularity might have peaked, and its stock price seems to reflect that. RBLX is currently trading at $60.47 a share with a market cap of $37.97 billion, and its quant score a concerning 21.0, indicating potential overvaluation. This is further supported by its extremely high PEG ratio of 192.31 and a negative forward PE of negative 1.63. What's even more alarming is RBLX's negative return on assets of 11.8% and a return on equity of negative 70.1%. These numbers suggest that Roblox is struggling to generate profits and utilize its resources effectively. While their quarterly revenue growth remains strong at 28.8%, their quarterly earnings growth is stagnant at 0%. This indicates that Roblox might be facing challenges in converting its revenue into actual profits. Overall, Roblox's high quant score, coupled with its concerning financials, raises serious questions about its long-term viability. While the gaming industry is constantly evolving, Roblox needs to adapt quickly to remain competitive. Next up, we're diving into the world of social media with Snap Inc., the company behind Snapchat. Despite facing fierce competition from the likes of TikTok and Instagram, Snap has managed to carve out its own niche, particularly among younger demographics. However, Snap's current financials paint a bleak picture. With a share price of $11.97 and a market cap of $18.06 billion, the company's quant score is a worrying 17. Their P/E ratio is an astronomical 496.06, with an even worse forward PE of negative 0.58. This suggests that the market has extremely low expectations for Snap's future earnings, which, based on their current performance, seem realistic. Snap's return on assets is a dismal negative 7.66%, and their return on equity is even worse at negative 40.6%. These numbers indicate that Snap is struggling to generate profits and utilize its resources effectively. While their quarterly revenue growth remains somewhat positive at 15.5%, their quarterly earnings growth is stagnant at 0%. This suggests that Snap is facing challenges in converting its revenue into actual profits. Overall, Snap's high quant score, coupled with its concerning financials, raises serious questions about its long-term viability. While the social media landscape is constantly evolving, Snap needs to adapt quickly to remain competitive. Finally, let's wrap things up with Coupang, the South Korean e-commerce giant that's often referred to as the Amazon of South Korea. With a share price of $22.42 and a market cap of $39.54 billion, CPNG has garnered significant attention from investors worldwide. However, CPNG's quant score of 15.0 suggests that the company might be overvalued, especially when you consider its P/E ratio of 38.56 and a forward P/E of 95.24. Now, don't get me wrong, CPNG has some positive aspects. Their quarterly earnings growth is a healthy 26.9%, indicating strong profitability. But here's the catch. Their quarterly revenue growth is a concerning negative 22%. This significant drop in revenue raises questions about the sustainability of their growth trajectory. Additionally, CPNG's return on assets is a meager 0.57%, and their return on equity is a low 1.52%. These numbers suggest that Coupang might not be utilizing its resources as efficiently as it could be. Overall, CPNG is a complex company operating in a rapidly growing but highly competitive market. While their recent earnings growth is impressive, their high quant score, declining revenue, and low returns on assets and equity warrant caution. That's it for this week's episode of the QuantScore Financial Show. We covered a lot of ground today, from Chinese EVs to South Korean e-commerce giants. Remember, the QuantScore is just one tool in your investing arsenal. It's crucial to conduct your own thorough research, considering factors like industry trends, company management, and overall market conditions. Remember, this video is for educational purposes only, and not financial advice. Investing in the stock market always carries risks, and it's essential to make informed decisions that align with your own financial goals and risk tolerance. Don't forget to like, subscribe, and hit the notification bell for more weekly stock analysis. We'll be back next week with a fresh batch of companies and insights to help you navigate the exciting world of investing. Thanks again, and until next time, stay calculating, my friends.